Just over half an hour now till the opening bell on Wall Street. Joining us now on the markets, Matt Powers, President, Managing Partner of Powers Advisory Group. You don't think things are cheap either, Matt. You do point out that the big caps and the seven that lead the way. There's 493 other ones. Do you think we're overvalued, like David Tepper?
Yeah. Good morning, Joe. Thanks for a happy Friday. Yeah, I mean, valuations are clearly stretched. They're high, they're frothy. It's kind of whatever you want to call it. I mean, if you're entering the market right now, you're paying up. And the S&P is trading at multiples we haven't seen in a long time. I mean, the index has become so top heavy that it's kind of just like a real proxy for just a handful of companies. So I think that's where the risk sits. If one of those names stumble, I mean, we're going to feel it across the index. So here's what's actually healthy. Looking at the positives here, the equal weight S&P has some hints of outperforming the cap weight. We just saw it yesterday in small caps. August rallied 9%. Russell 2000 outperformed the S&P over the past month, and it's I think 7th straight weekly gain, so longest rally in 5 years. Plus, the majority of sectors are still trading below the index multiple. So to me, I think that's just kind of a sign of we're at this inflection point where leadership could start broadening and beyond just the mega caps into small caps and maybe some other rate sensitive type areas.
Been a long time. Been waiting for that for a while. So many people have, small caps been recommending that. It hasn't come to pass. You think this is real this time?
Yeah, just drilling down to small caps, it's kind of interesting. They've been left behind for years. I mean, they got crushed during COVID, but when rates started to ease, when rates do ease, it changes the math. You can say smaller companies, they tend to carry a lot more floating rate debt. So lower borrowing costs. I mean, it drops just straight down to their bottom line. So, I mean, you're also you're seeing investors look for areas of the market that haven't already been bid up to death, like to extremes, like large caps and some of the mega caps have. And small caps are still trading at a discount to large caps. So it makes them attractive as money rotates into new leadership. But just the way I look at it, falling rates kind of create the setup for somewhat of a catch-up trade in small caps. And if they participate, it's a good thing for the economy. It makes the whole broad-based rally more sustainable just in general. So, just throwing an ETF out there, IJR is the iShares Core S&P small cap ETF. It only holds profitable companies. So, that's one ETF we look at in that area.
Do you, are you like 60% stocks, 40% bonds, 10% cash, or all you care about are trying to pick the right equities?
No, it's asset allocation. I mean, that's key. Obviously, it is for any client we've got. You have to tie back your investments to your overall risk profile. I mean, that's standard advice. Anyone should be telling their clients that.
Are bonds going to go up, or are bonds going to come down? Like
if I could
let's say 8 years. Yeah.
I mean, good question. If I could predict rates, it'd be a totally different conversation. We're telling clients really you need to extend your duration just a little bit. You capture a little bit of a higher yield and potential for some principal appreciation. I've had this conversation a few times on the network about money market funds too. There's $6 trillion sitting in money market funds, and over $1 trillion's come in the past year alone. So, as that rate starts to come down, and this is a conversation, I mean, we have it all the time with clients. It's what do we do? When the rate comes down, where do I shift this risk-free yield I'm getting of over 4%? And, I think, you have to start looking, and that's where the duration comes in. But the other part to that, too, is there's this talk, and I don't know that there's a definitive answer, that some big flood of cash is going to come into the market from these money market funds. And, it's some of the underappreciated areas of the market. And I'm not so sure that's the case, but if it is, you're looking at basically relative to the S&P, money market funds are at 15%, absolute $6 trillion is a huge number, but historically it's about 20% of the S&P relatively speaking. So, if that makes sense.